Hello and welcome to Credit Compass, your guide to navigating European credit markets. This week we start in the Gulf. Not the geopolitical headlines that have been driving oil and risk sentiment, though those remain important, but the other Gulf story, the UK's newly concluded free trade agreement with the Gulf Cooperation Council. We will also look at the European Central Bank's latest work on private credit and financial stability. The message there is nuanced. Private credit is not yet a euro area banking system crisis in waiting, but it is becoming a more important transmission channel for market stress. And finally, we turn to artificial intelligence in asset management. Mercer's latest survey suggests that AI is no longer theoretical for investment firms, but is still mostly acting as a co-pilot and not the pilot. All right, let's dig in. First, the Gulf. Geopolitical headlines across the Middle East remain a live input for markets, especially through the oil prices, inflation expectations, and risk appetite. The practical point for credit investors is simple. When energy prices and geopolitical risk premium move quickly, they can spill into rates, spreads, and sector dispersion. So we will keep watching that channel closely, but there is also a more concrete Gulf development. The UK has concluded negotiations on a free trade agreement with the Gulf Cooperation Council. Now, this includes Bahrain, Kuwait, Oman, Qatar, Saudi Arabia, and the United Arab Emirates. The UK government has described this as the first comprehensive free trade agreement between a G7 country and the GCC. The legal text still needs to be finalized and legally verified and then signed. After that, the agreement must go through the relevant UK and GCC processes, including UK parliamentary procedures and ratifications and so on. So this is a meaningful commercial milestone, but business cannot yet trade under the agreement's full terms, although it should not be far off. The UK government says the GCC has a combined GDP of around £1.9 trillion, a population of more than 62 million, and an import market worth about $1 trillion. The total UK GCC trade was worth $53 billion in 2025, making the GCC equivalent to the UK's 10th largest trading partner. The government estimates that the agreement could add $3.7 billion a year to UK GDP in the long run, increase real wages by £1.9 billion annually, and raise bilateral trade by nearly 20% or £15.5 billion a year against 2040 projections. For goods exporters, the tariff package is the most immediate part of the story. The GCC is expected to liberalize 90% of its tariff lines within 10 years of entry into force. Tariffs are expected to be removed on around 93% of current UK exports to the GCC, equivalent to an estimated $580 million a year in duties once fully implemented. Around £360 million of those duties are expected to be removed on day one of the agreement entering into force. The beneficiaries are broad: aerospace, machinery, electronics, automotive, medical devices, skincare, and food and drink. UK food and drink exports to the Gulf are already worth £839 million, and the government points to immediate tariff removal once the agreement enters into force for products including things like cheddar cheese, chocolate biscuits, smoked salmon, pet food, and animal feed. For credit markets, the services and financial services provisions are important and may be just as important as the goods package. The agreement is designed to lock in market access and regulatory certainty across sectors such as legal services, engineering, construction, financial services, fintech, and telecoms. In financial services, the government says the GCC has agreed its best terms to date, including binding commitments on the free flow of financial data, the ability to store and process financial data outside the region, and restrictions on unjustified data localization requirements. For banks and asset managers, insurers, and fintech firms, the ability to process data efficiently can affect scalability, compliance, and the economics of regional expansion. The deal also includes modern provisions on digital trade, investment, mobility, intellectual property, and procurement. It supports paperless trade and electronic trade documents, protects open internet access, guards against forced disclosure of source code or cryptographic information, and creates a framework for cooperation on AI and emerging technologies. On mobility, the UK says it secured the GCC's most ambitious business mobility commitments to date, including improved visa access and greater certainty around length of stay. On procurement, legally binding commitments initially apply to Bahrain and the UAE, with a review mechanism for other GCC members within 2 years. This is a commercially meaningful UK trade deal, especially for goods exporters, professional services, financial services, digital trade, infrastructure, healthcare, clean energy, and advanced manufacturing. The near-term limitation is implementation. The agreement has been politically concluded, but the practical benefits depend on final legal text, signature, ratification, and business take-up. Now, let's turn to private credit. As part of its financial stability review work, the European Central Bank has published a special feature on stress in global private credit markets and the implications for euro area financial stability. The ECB's view is measured. Private credit risks are real and they are becoming more relevant for financial markets, but the asset class does not currently appear large enough to pose a standalone systemic threat to euro area financial stability. Private credit in this context generally means originated lending by non-bank financial institutions to companies, rather than loans arranged and syndicated throughout the banking system. The appeal of the asset class is clear. Borrowers may get faster, more flexible financing, and investors may earn an illiquidity premium. The risk is also clear. Less transparency, less frequent valuation, weaker market liquidity, and potential concentration in riskier borrowers. The ECB estimates that private credit funds managed from euro area headquarters had around 100 billion euros in assets under management in 2025, after growing at an average annual rate of 14% since 2010. That is fast growth, but from a relatively small base compared with public bond markets, bank lending, and the much larger US private credit market. Euro area banks' exposure to private credit is estimated at 62.5 billion euros, equal to about 0.2% of total bank assets, or 2.5% of total equity. Insurers and pension funds have larger direct exposures, about 211 billion euros for insurers and 52 billion euros for pension funds, equal to 2.3% and 1.4% of total assets, respectively. The ECB also notes that exposures are concentrated in a relatively small number of large institutions. That makes the aggregate numbers reassuring, but the institution-level risks are more relevant. The ECB highlights several recent concerns: defaults linked to First Brands and Tricolor, both of which involved lending from the banking sector and drew attention to weak underwriting standards, opacity, and the ease with which leverage can accumulate in parts of the private credit ecosystem. The ECB also points to deteriorating interest coverage among euro area private credit-backed firms, especially compared with firms funded by bank loans. There is also a sector concentration angle. Private credit has meaningful exposure to software and IT-related borrowers. Advances in AI could disrupt some software business models, putting pressure on cash flows, as we have heard lately. A sector-specific shock would not necessarily stop at private credit. It could also affect leveraged loans, high-yield bonds, equities, and listed private market managers. For markets, the ECB argues that the key implication is that private credit should be viewed less as an isolated illiquid loan book and more as a potential risk sentiment amplifier. The ECB highlights redemption pressure in U.S. semi-liquid private credit vehicles, including business development companies or BDCs. These outflows have raised doubts over future private credit growth and weighed on listed private market firms' equity valuations. The ECB performed a stress test exercise on the industry and is central to their conclusion. The ECB models a severe scenario with a 10% default rate and 50% loss given default on general private credit exposures, plus a much harsher 30% default rate and 80% loss given default for software exposures across private credit, leveraged loans, and high-yield bonds. It then adds broader second-round effects, including a 30% equity price decline and a 25% valuation shock to high-yield bonds. Now, that's a pretty stressful scenario, and under that framework, direct private credit losses appear manageable. The larger losses come from the actual second-round public market valuation effects rather than the private credit exposures. For banks, losses do not exceed 1.3% of total equity in the ECB's exercises. Insurers and pension funds are more exposed through broader portfolio valuation losses, particularly through equities and high-yield bonds. So the conclusion is not really alarmist. Private credit is not currently a euro area banking system crisis in waiting, but it is a growing source of financial market vulnerability. The concern is not simply that private credit losses will overwhelm banks. The stronger concern is that a confidence shock could expose weak underwriting, opaque valuations, concentrated exposures, and liquidity mismatches, and then force repricing across high-yield credit, leveraged loans, and listed alternative asset managers, equities, and institutional portfolios. And that is why the ECB calls for closer monitoring of any data gaps, liquidity mismatches, leverage, and cross-border exposures. It also flags a forward-looking issue. Private credit could become more macro-relevant if it expands into AI-related financing, especially data centers and software-linked borrowers. Expected productivity gains and future earnings from AI remain uncertain, and if private credit exposure grows quickly and AI-related cash flows disappoint, the asset class could become a more material source of credit risk and a stronger amplifier of stress. In market terms, the ECB message is vigilance, not panic. The present risks look manageable, but the direction of travel, faster growth, semi-liquid structures, opacity, and AI-linked concentration makes private credit an increasingly important variable for credit investors, insurers, pensions, and broader risk sentiment. Now, on another AI-related note, Mercer has published a report on AI adoption in the asset management industry. The headline is that AI adoption is now real and widespread, but still mostly augmentative rather than autonomous. Based on Mercer's February 2026 survey of 131 global asset managers, 55% have integrated AI into at least one investment process. 27% are still at pilot or proof of concept stage, and 91% plan to increase AI use over the next 12 months. Only 5% currently grant AI autonomous or semi-autonomous authority for investment recommendations or trades. That distinction is important. AI is changing how investment work gets done, but it is not yet broadly replacing portfolio managers or investment committees. Most use cases are still upstream, automating routine work, supporting research, generating insights, summarizing information, and improving operational efficiency. Mercer says the clearest measurable gains are operational. 69% of firms cited enhanced operational efficiency, and 55% cited faster or higher quality insights. By contrast, only 8% reported measurable improvements in investment returns, and only 8% reported reductions in portfolio volatility. So, the message for asset owners and allocators is to move beyond generic AI-powered claims. The diligence question is not, do you use AI? It is, where do you use it? How is it governed? How is it validated? And how do you monitor whether it still works? The key risks are familiar but important: data quality, access to proprietary databases, vendor dependence, weak governance, overfitting, look-ahead bias, cybersecurity, licensing, privacy, and model degradation. Mercer notes that data quality or access is a material barrier for 69% of firms, while regulatory or compliance concerns are a material barrier for 59%. There is also a workforce angle. Mercer's Global Talent Trends 2026 report, which was released back in February, based on a wide cross-industry survey of nearly 12,000 executives, HR leaders, investors, and employees, found that 98% of executives are planning organizational design changes over the next 2 years. It also found that 65% expect 11% to 30% of their workforce to be redeployed or reskilled because of AI over that period. That is a more nuanced story than simple job destruction. AI may reduce the need for certain tasks, but it also creates demand for new skills, new workflows, and new human-machine operating models. Harvard Business School research adds further texture. Looking at job postings after the launch of ChatGPT, researchers found that postings for occupations involving structured, repetitive tasks fell by 13%, while demand for analytical, technical, or creative roles, jobs more likely to be augmented by AI, rose by 20%. The largest reductions were concentrated in finance and technology. So, where does that leave AI adoption and asset management? It is already changing workflows, it is already improving speed and efficiency, but the evidence for better investment returns is still limited. For now, the more defensible conclusion is that AI is an operating leverage story before it is an alpha story. That may change as tools improve, firms with better data, stronger governance, and clearer investment use cases may build durable advantages, but the bar should be high. In markets, a model that works in a backtest but fails in production is not an innovation. It is a risk event waiting to happen. So, where is the focus in markets this week? Well, the focus remains on sovereign curves, fiscal credibility, inflation uncertainty, and dispersion. Higher financing costs still matter for corporates, especially those with floating rate debt, near-term maturities, or weaker cash flow coverage. In that environment, credit selection remains central. The market still appears to be looking for reasons to rally, but that also means negative surprises can matter more than positive ones. When positioning is optimistic and spreads are tight, disappointment tends to travel quickly. The practical takeaway is familiar. Stay disciplined, watch the tails, and pay attention to dispersion. In this market, the average spread rarely tells the whole story. That's all for this week's edition of Credit Compass. Before we go, a quick note on our new publications. As mentioned last week, we have launched Macro Pulse, a weekly short report built around one chart. It comes out after the podcast and newsletter and takes one of those themes that we discussed today and brings it to life visually. Second, we have launched our monthly bearings, a monthly review that looks back across the key macro and credit themes from the previous month. Watch out for that one next week. You can find these and other reports on macro and credit trends by visiting kbra.com/macro credit. Until next time, stay curious, stay informed, and stay resilient. Let Credit Compass guide your way.